Hi guys, I am VP. In this video, we are going to see the Chapter 11 in the book The Intelligent Investor. The Chapter 11 is the security analysis for lay investor or general approach. It's nothing but how an individual investor should approach the market in the analysis of bonds and stocks. Okay, let's get started. You can categorize the chapter into three parts. The first one is what is the role of a security analyst, and the second one is how to analyze the bond and how to analyze a stock. Okay, the security analyst or a financial analyst. His role is to analyze the securities like bonds and stocks, also the economic factor. The security analyst must know how to analyze the economic factor in the internationally and as well as the domestic level in the market which is he going to invest. The analyst who should not well versed in the analyzing in bonds and stocks, rather than he should be well versed in the economic and macroeconomic factors, and he should also well versed in the monetary policies of the local government and also the World Bank monetary policy. Okay. The main role of the analyst is to analyze the past, present, and the futures of the any given issue. He is going to describe the business and summarizing the operating results and the financial positions. He is going to point out the strong and the weak points in the company and evaluate the what are the probabilities of risk is applied in the issues, and at his best guess he is going to estimate the future earnings power of the company. If everything finds attractive to him, then only he is going to evaluate the business and find the correct price to invest or buy the stock in the company. Okay. The standard way of analyzing the company is by seeing the past average earnings, and we should also consider how much the shareholding pattern of the company and the capital structure and the working capital, how much the company requires, and also the asset value and how much debt or loan does the company have. We should also check every parameter in the struggling period or in a less demand period, how the company is making its decision and coming out of it. We should also check that. Okay. For lay investor, the first thing he should see is study the annual report of the company. It is the first step to analyzing the any company. He should download the past 5 years annual report of the company, and he should start reading, and he should get more information about the company, and he can get a view or conclusion from reading that. Okay. According to them, we may have two important questions as for now. The first one is what are the primary tests to do for a safety of the issue, and second one is what are the chief factors entering into the valuation of the company or a common stocks. In security analysis, first we are going to see how to analyze a bond. We all know how bond works. The issuer collect some amount of money called the principal amount, and for the principal amount he will pay a interest for that in quarterly or even monthly or even annually. Okay. At the end of the maturity period, the issuer will pay us the principal amount and the interest payout for us. We should analyze that whether the bond issuer will give our interest amount and the principal amount at the maturity period. Okay, to know that, Graham gives us a formula for that. The formula goes like the chief criteria used for bond is the number of times that total interest charges have been covered by the available earnings for some years in the past. Okay, let me explain it in a simple way. It's nothing but how much times the company can provide us the interest amount with their available earnings in the past period of times. Let me give you an example. If the company has an available past earnings of let's say 1 crore, then with that 1 crore, how much times the company can pay back the interest amount to the bondholders. It is what Graham says. The more number of times they can provide with their past average earnings, the company is a stable one. We can consider buying that bonds. Okay. This method of seeing the past earnings of the company is called earnings coverage ratio method. Okay. With this earnings coverage ratio, we also consider seeing the three important things that are size of the enterprises, stock to equity ratio, and how much assets the company have. After seeing this in the annual report or the balance sheet of the company, we can conclude a decision whether we should buy the bond or not. Okay. Ragam is the important thing. As for now, we are studying the company's past and present situations which are available in the annual report of the company. But how one can predict whether the company will pay out the interest and the give back principal amount in the future? The answer one can find only by his experience. Okay. Now we are going to see the common stock analysis. The diagram says the ideal way of doing this is by finding out the valuation of the company and comparing it with the current market price, whether the company is attractive to buy or not. It is the ideal way for the analysis of a stock. Now we are going to find the valuation of the company, and we are going to compare it with the current market price, and we are going to make the decision whether we should buy or not. Okay, Graham says for the valuation, one should look out the valuation in turn would ordinarily be found by estimating the average earnings over a period of years in future and then multiply by the estimated by an approximate capitalization factor. The capitalization factor is nothing but the income expected from an investment in a volumetric form. Okay. Graham also says the future earnings. Earnings is nothing but the income. We all know the past earnings from the annual report or from a financial statement of the company. What we should do is we should average the growth amount in percentage, and we should also expect that growth for the company in the future also. By that we can find the future earnings growth of the company. Okay, Graham also want us to know about the operating margin. Operating margin is nothing but operating income divided by the revenue in percentage. The operating margin percentage should be always higher. Okay, now let us see the factors that affecting the capitalization factor. Capitalization factor is nothing but the income what we are expecting from an investment in a percentage term. Okay, the first one is the long term perspective. No one knows what is going to happen in future that will affect an income while we are estimating it in a long term perspective. Okay, second one is the management. We don't know about the management also. Even though we study more about the management in the annual report in the financial statement, even though in the news of the company, as individual investor we cannot know 100% about the management of the company. Always we should select the company with the management with a high work ethics in them. The third one is financial strength, and is nothing but how much debt the company is having and how much revenue they are maintaining and how much revenue they are generating from their sales, and whether they have the capacity to pay off the debt interest for their bondholders. This all the financial strength. The capital strength is nothing but if further any acquisition needed, or if further any investment for their upcoming product needed, whether they have the capital reserve for that. That is the capital strength of the company. The fourth and fifth is about the dividend record and the dividend yield of the company. A good company, while making profit, it also consider shares its profit with the shareholders as a dividend to it. Okay, and investors should also consider that also. Now let us see the what Jason Sweck said about this chapter. The one main thing Jason Sweck said is no one knows about the future of the company. We can estimate by knowing the past data, so that expecting that the company will perform as same in the future. Okay. To summarize this chapter, the main takeaway is how much we are reading about the company through their annual report and their financial report. That much well we can know about the company. We should always consider reading the financial report for the past 5 to 7 years to know about the past performance and an average past performance. And the one thing we should keep in mind that how exciting the business is not important. At what price we are buying it. We should always buy at the correct valuation. The main thing is the price is what you pay and value is what we get. Okay. In next chapter, we are going to see the per share earnings or earnings per share in a detailed way. Thank you. Stay tuned.